Zacks Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. Well, this time around, the top technician here at Zacks.com and the top options guru, Kevin Matras, is talking about the lottery ticket.
Nice.
If that's not gambling, I don't know what is. And you're always saying that the markets are not gambling. So I don't know. Can I take the winnings from this and go spend it, or I should hang on to it for a while, or what?
I'd say you may want to hold off just a bit. Look, in these last several Know Your Options pieces, I've been outlining some unique strategies, but they have been pretty conservative. And I figured today I was going to kind of go into a different direction.
Yeah, gambling.
Well, the reason is there's a lot of different ways to play this stuff, but options do afford the investor a tremendous amount of leverage, and you can take advantage of this with a very small amount of money and a very limited amount of risk.
Okay.
And the reason why this is interesting is because there are times where you just have a strong feeling about a market, or maybe you have a hunch that something really big is going to take place. And for those times, you may want to, be a little bit more speculative. And if you're really trying to be able to take advantage of some spectacular move, there are ways and there are strategies to really figure out how to strike it big if it does hit. However, it should be reminded to everybody that these types of long shots, that is exactly what they are. These are long shots, and this kind of strategy should not be considered part of a sound and repeatable way to invest your money over and over. This is one of those things where you see something, you think something big is going to happen, and you may want to just take a gamble on it.
Gut feeling. Okay,
Right.
So disregard the G word. How do we do it?
First off, let me just say that, like I said, these are long shots. They don't pay off that much, and it is important to remember to only put in what you are willing to lose. Now, if let's just say that you are going to try to implement this strategy and you're going to try to limit some of your investment, just be prepared to be able to pull the plug on this investment if you see the trade starting to fail. A lot of people are afraid to take their losses. Just remember, if you're only willing to risk a portion of it, you're going to have to be vigilant, stay on top of this thing, cut your losses if you see the stuff is just not working out.
Okay, so how do we do it?
All right.
He asked for the second time.
Well, let me get all these disclaimers out of here. So the example I'm going to use today is with a company like Ford. Ford, as you know, they have had their troubles. All of these car makers have had their troubles. But let's take a look at it. Ford right now is trading right around $720. But let's just say you thought that Ford was going to do something spectacular. Mm-hmm. Let's say you looked at the chart like we're doing right now. You see there's a really nice consolidation pattern, and you're thinking, we may see Ford blast off higher, maybe a 50% return or even a 100% return. So you got to ask yourself a question, what should I do if something big like that does happen? And the answer that we're going to discuss today is using out-of-the-money calls. So let me show you how this trade works out.
Yeah,
right?
Go slow because I'm writing this down.
Good. You don't have to ask me 3 times. All right. So let's say that I'm trying to figure this thing out. I want to look at 2 different kinds of options. So let's say I'm deciding between the September 2009 calls, which has about 2 months of time on it, and let's say I'm also looking at the December 2009 calls. I believe that has about 143 days worth of time.
Okay.
If I'm expecting something to happen pretty quickly, you may decide to make the decision to purchase less time, but if the trade takes a little bit longer, you may find your options expiring before your big payoff. So as a rule of thumb, unless there's a specific event, I think it's never a bad idea to get a little bit more time. So let's say we decide to do the December 2009 options. Mm-hmm. That has about 143 days worth of time as of today. And
today being July 30th.
Right. So now we have the month that we're going to be looking at. Now it's time to figure out what strike price. So I've already decided I'm going to be doing the out of the monies. And again, if I'm expecting Ford to double in price, go to 7 to 14. If I looked at the $9 calls, those $9 calls are going for 38 cents with a delta of 0.31. which means a simple $1,000 investment would buy me or would get me 2,631 $9 call options.
Okay.
Now I also can look at the 10s. The $10 calls are going for 21 cents with a delta of 0.212. The $1,000 that I plan on investing would get me about 4,761 $10 calls. Now, for this example, I am not factoring in commissions. So just remember that when you're deciding what trades you're going to be putting on, that there are commissions involved.
No commissions. Okay, got it.
So here's how it works. If at expiration, Ford is at $9, remember it's at $7.20 when we started. If Ford is at $9 or less, that means Ford has increased in value by roughly 20%, great stock move, but those $9 calls would be worthless, and I would have lost my entire $1,000, which is 100% of my investment. There's no intrinsic value at that point. There's no time value. So again, those options are worth zero.
Right.
If, however, Ford went to $10, for example, now my $9 options are worth $1 each. So that means $1 times 2,631 calls. That means I've got a value of $2,631 on my $1,000 investment. That's 163% gain. Now again, it's a great percentage gain, but not so much dollar-wise for the kind of risk that I'm taking, okay? So now let's look at the $10 calls.
All right.
My $10 calls would be worthless as there's no intrinsic value or time value left, so I would have lost my $1,000 in this case. Ford would actually have to get above $10 in this example for me to see any kind of payoff, okay? But if Ford went to $11, once again, we're talking about big moves, right? If Ford went to $11, that's an approximate 50% move on the stock, which means those $9 calls would now be worth $5,263. That's a 426% return. And the $10 calls would be worth $4,761. That would be a 376% return. Once again, good returns, but not quite lottery ticket returns. Remember, the closer to the money options that you have, the better performance you're going to see if you see a small move. But we're talking about seeing a huge payoff. So the only way these out-of-the-money calls are going to have the big returns is if you see a really big explosive move. So check it out. If you're right, and you did see the price of Ford go from $7 to $14, you saw the market do what you thought. The $9 calls would now be worth $13,000, right? That's a 1,216% return. The $10 calls would be worth over $19,000. That is an 1,800% return. And if you had the $11 calls, your returns would be even bigger, and all of that is being seen on just a $1,000 investment. But of course, the deeper out of the money calls you buy, the more you can buy, and the more you can buy, the bigger your gains are going to be. But again, these are completely long shots.
Yeah, not quite money that I could retire on, but what sticks in my mind, though, is that if you're not right, like they say at the ballpark, you're out.
Right. So again, the illustration that I was giving is if let's just say you do see a 25% return or 30% return, which for a stock is fantastic, if you were to buy in the money calls, at the money calls, or something very, very close out of the money, you would have fared a lot better. The only time these deep out of the money calls are going to really make any sense is if you can get a lot of them, right? You want to get a big payout, and you are going to have to see a big move. So again, it's a high-risk strategy, not so much because of the dollar spent, even though you could lose 100% of that. It's a high-risk strategy because there is a great unlikelihood that you're going to see a stock make a 100 or a 200% move. But understand, there are stocks that do that. And I'll give you a couple of examples. You take a stock like STEC, for example, STEC. I think they make DRAM chips and memory chips and this kind of thing. I think in April, I think they were trading at like $9. And I think a couple of days ago or something, I think they were trading over $34. So that's about a 277% increase on the stock. And if you apply the kind of crazy leverage that we just got done talking about, that could potentially have equated to a 3,000 or even a 4,000% move. Or let's take Bristol Myers, for instance, right? Bristol Squibb Myers, I believe they bought Matras, I think it was last week.
Bristol Myers Squibb.
Yeah, Bristol Myers Squibb. They
Them
bought
too.
right. They bought Matras, and I think they were paying like over $2 billion, if I'm not mistaken. They were paying $16 for the stock, but prior to the announcement, that stock was trading at like $8.40. So that was a 90% return, literally overnight. If you went into this thing thinking, hey, I think they're a good takeover target, that could have been a way that you could have really leveraged yourself to take advantage of something that you really were hoping or expecting to see happen. So again, this kind of strategy, straight up long shot, crazy lottery ticket. If you hit big, but if it does not make those silly moves, you're out.
Do you own any of the stocks that you've talked about in the examples?
Not yet.
All right. Come back with something that I can retire on like next week, would you?
Yes.
All right. Just again, more information delivered by the options guru himself here at Zacks, Kevin Matras. Information that will help you to know your options. With Kevin, I'm Terry Ruffalo.